Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Suncor stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Suncor's specialty is the production of synthetic crude from oil sands. This is just one of the many ways to extract oil. The sand is removed from the ground and put into trucks, which are brought to crushers, where the large clumps of earth are processed. Once the oil sand is crushed, hot water is added so it can be pumped to the extraction plant. What I just explained to you is called the upstream part of the oil and production process. Suncor is an integrated oil and gas company, so they're also involved in the downstream part of the process, which is refining and marketing. Upstream is the exploration and production part. Some companies are only involved in the downstream part, such as Valero or Phillips 66. Other companies are just involved in the upstream part, such as Canadian Natural or Occidental Petroleum. Midstream is the storage and transportation part of the process. Examples of midstream companies are Enbridge and MPLX. Suncor was selling retail gasoline using the name Suncor until it acquired Petro-Canada in 2009, and it changed the name of all of its Suncor gas stations to Petro-Canada. There are over 1,500 Petro-Canada retail gas stations. You may be thinking to yourself, I know I've been to a Suncor gas station. I see them all over the place. You will find Suncor gas stations all over the United States, but those are owned by Energy Transfer, ticker ET. I recently bought some stock in ET. The Suncor Renewable Energy Division includes interests in 4 wind farm operations in Ontario and Western Canada. Also the 40-mile wind power project, which was restarted in early 2021 and is currently planned for completion in late 2022. The company has been increasing its investments in clean technology, including LanzaJet. LanzaJet is a company working to bring sustainable aviation fuel and renewable diesel to the commercial market. And the Varennes Carbon Recycling Facility, a biofuel plant in Varennes, Quebec that is designed to convert commercial and industrial non-recyclable waste into biofuels and renewable chemicals. Suncor is also one of the largest Canadian retailers of petroleum products. It is headquartered in Calgary, Alberta, Canada, and was founded in 1919. Alberta is one of the largest producers of oil on the entire planet, and this company is a big part of that. The stock trades on the TSX, New York Stock Exchange, Mexican Bolsa, Deutsche Börse, and Swiss Stock Exchange. Let's get started with the model. We're going to look at the ticker that trades on the TSX. So all the numbers in this video are in Canadian dollars. This is a large cap company, 55 billion market cap. They're trading at $38 a share, and they have 1.4 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they generate tons of free cash flow. It was negative in 2020 due to lower oil prices. But look how high it is in 2021, over 7 billion. Free cash flow is a cash flow that's remaining for the investor. The company can pay a dividend with that free cash flow, buy back stock, they do both of those, or invest back into the business. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that also looks really good in 2021, over 4 billion. Revenue is the sales for the company, and that's pretty steady except for 2020, it dropped a lot. But their revenue is not that much higher in 2021 compared to 2018 and 2019. But their free cash flow and net income are a lot higher. So they're more efficient and more profitable. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. This includes all the costs to pull the oil from the ground, refine it, and process it. Revenue minus cost of revenue gives you your gross profit, and that peaked in the trailing 12 months at $19.5 billion. It was $18.7 billion in 2018, but it's more than triple from 2020's number. Below that is their operating expenses. This includes marketing, depreciation. Gross profit minus operating expenses give you your operating income. That was highest in 2018. It's a little lower in the trailing 12 months, but it was negative in 2020 because their revenue was so low because oil prices came down so much. Below that is the interest they pay in their debt. It was about $1.3 billion in 2021. Below that is other income and expenses. These are all the gains or losses not part of the company's core operations. This is likely the gain on the sale of an asset. This negative here is likely an asset impairment. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income, which was the highest in 2021 at $4.1 billion. This is the company's income statement from the latest quarterly report. This shows us all of 2020, all of 2021, the fourth quarter of 2020, and the fourth quarter of 2021. And their revenue in the fourth quarter almost doubled from $6.6 billion to $11.1 billion. And in 2020, it went from $25 billion to $39 billion. They spent $4.1 billion in the purchase of oil and products, $3 billion in operating and selling expenses, and the oil needs to be transported either by truck or pipeline. That was $380 million. $1.6 billion in depreciation, depletion, or amortization. Their operating income in the fourth quarter was $2 billion. In all of 2021, it was $5.6 billion. So they crushed it in the fourth quarter. And their net income is $1.55 billion. It was negative in the fourth quarter of 2020. In 2020, their net loss was $4.3 billion. In 2021, their net profit was $4.1 billion. Here's a breakdown of the company's oil. For synthetic crude oil, they produce 515,000 barrels of oil per day. For bitumen, that's 151,000. Bitumen is a heavy crude oil found in sand deposits. And the tar sands region in Alberta, Canada is the third largest petroleum reserve in the world. And their refinery is at 96% utilization. And they refine 447,000 barrels of oil per day. You can see their numbers in the fourth quarter of 2020 are pretty similar to the fourth quarter of 2021, but they're so much more profitable in 2021 because oil prices are so much higher than 2020. They process a fairly similar amount of oil in Eastern North America and Western. Their refinery utilization is also fairly similar in the mid to high 90%. They refine 233,000 barrels of gasoline per day and 238,000 barrels of distillate. When you see refined oil, that means converting crude oil into a use, like fuel for transportation, heating, electricity. Refining breaks down the oil into various components, and those components are then reconfigured. When you pull oil from the ground, there's no use for it. You can't use it for anything. You have to refine it to put it to practical use. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you can see they generate tons of cash flow, almost $12 billion in 2021. That's the cash that's remaining after paying all your day-to-day expenses. And then you have your capital expenditures, which are investments in property, plant, and equipment. They spend a lot on CapEx, between $4 and $5.5 billion a year. Here's a breakdown of their CapEx. $860 million they spent in oil sands, $73 million in exploration and production, $188 million in refining and marketing. If they bored an oil well to stop pulling oil from the sand, the cost of that well would be part of this $860 million. And if they bought trucks to move the oil around, that may also be part of this, or possibly part of one of these two. And then it's carried on the balance sheet and depreciated over its useful life. Operating cash flow minus CapEx gives you your free cash flow, and they have lots of free cash flow in 2021, $7.2 billion. The two ways to reward investors are to pay a dividend or to buy back stock, and they do both. And it looks like they've been decreasing their debt load the past few years. In 2021, they issued $1.4 billion of debt, paid down $2.8 billion. So their debt decreased $1.4 billion in 2021. And they bought back lots of common stock in 2021, $2.3 billion. Not much in 2020 because they didn't have much cash flow. But they bought back over $2 billion in 2019 and over $3 billion in 2018. In the fourth quarter of 2021, they bought back 21 million shares of common stock at a cost of $30.65. So it cost them $639 million. In all of 2021, they spent $2.3 billion on buying back stock. In 2020, it was only $300 million. And look how much higher the price was in 2020. They're getting a great deal in 2021. It averaged $27. Here's a visual of their revenue since 2015. You can see it's pretty much at its peak right now. It was the lowest last year, Ideally, you want to invest in a company that has positive operating cash flow, and they do every year. The highest point for their free cash flow is mid-2019 and current. Their earnings are up and down. It was negative in 2016, it was the lowest in 2020, and now it's at the highest, similar to 2019. Now it's as high as 2018 and 19. But you want to make sure if revenue is increasing, their operating cash flow is increasing, ideally at the same rate, if not better. This is the company's operating cash flows from their latest report. 2020, 2021, the fourth quarter of 2020, and the fourth quarter of 2021. And the way you calculate operating cash flow, you start with your net income or net loss. That was $1.6 billion. We add back the non-cash items on the income statement, $1.6 billion of depreciation, depletion, amortization, and impairments. And everything else is pretty small. And then we have to adjust for changes in working capital. That was negative $529 million. So they generated $2.6 billion of cash flow. Last year, even though they had negative net income, they still generated $800 million of cash flow. But I'm not sure if that could even cover their dividend payment. Plus, they have to invest back into CapEx. This is the company's investing and financing sections from their statement of cash flows. All of 2020, all of 2021, the fourth quarter of 2020, the fourth quarter of 2021. So in CapEx, they spent $1.2 billion. Last year was $1 billion. They received $317 million from the sale of assets. In their investing section, they had a cash outflow of $800 million. Last year was $1 billion. In their financing section, they paid down $560 million of debt. They bought back $639 million of common stock, and they paid out $607 million of dividend payments. So that's like a double dividend payment, because they bought back a similar amount of common stock as they paid in dividend payments. In their financing section, they had a cash outflow of $2 billion. Last year was a cash inflow of $700 million, because last year they added $1 billion of debt. Let's look at the capital structure. $37 billion of equity, $18 billion of debt. They're 67% equity, 33% debt. This is their debt to equity ratio since 2015. They always keep a pretty good gap between debt and equity. You don't have to have zero debt, but ideally they would have less debt than equity. You can see the two lines are getting closer since 2020. Here's a visual of their balance sheet. It looks like a pretty solid balance sheet. They have $68 billion of physical assets. Physical assets are more valuable than non-physical assets like goodwill or trademarks. Because if you need cash, you could sell physical assets. You can't really sell intangible assets. They don't have that much cash, but they have positive operating cash flow, so I'm not too concerned about that. And their debt is a pretty small piece of this entire box right here. I gave them the highest whack on Finbox, 8.8%, and that's a discount rate we're gonna apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for that $63 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $67 billion. We divide that by 1.4 billion shares. And we get a calculated stock price of $46. They're trading at $38, so they're trading at a 17% discount. It's a buy according to the model. Their revenue is projected to grow 5.6%, which I thought was a reasonable number, so I grew it by that percentage for the next 4 years. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers, and I divided by these 4 revenue numbers. And that comes out to 11%, so I multiplied their future revenue estimates by 11%. That's how I got their future free cash flows. And all these free cash flows are lower than 2021, so they should be able to hit these targets. The last time I did a video on Suncor was just a few months ago in November. They were trading at $33, and my calculated stock price was $38, and they just surpassed $38. If the model is on point, on average it would take a year to hit that price target, but they did it in 3 months. Since they knocked it out of the park in the fourth quarter, that's why my new valuation is higher. The website Simply Wall Street's on another planet. Their valuation is over $100. 12 analysts price this stock, and the average price target is 34, the low is 29, the high is 42. This is where the stock has been trading the last 2 years. All oil and gas stocks crashed in April 2020. Remember when oil became negative at one point? But oil is such a vital commodity, of course it was going to come back. Now the price of a barrel is at its highest point than it has been in the past few years. When you invest in a company that's linked to a commodity, like oil, gold, silver, the price of the stock moves with the underlying commodity. So there's not much magic to predicting the stock price. If oil goes up, so will the stock. If oil goes down, so will the stock. So you can see the stock price pretty much tracks oil. Not exactly, but it's really close. If you invest in a company with really bad management, then the stock could do a lot worse than oil if they make a lot of blunders. With a company like this that's been around over 100 years, there's not too much risk about them making a really big blunder. This is directly from the company's reporting, and you can see the price has increased dramatically since the fourth quarter of 2020, pretty much in every single category. The cost to pull the oil, process it, and refine it is fairly similar year to year. It probably moves with inflation because you have to pay people a salary, you may have to upgrade your equipment, fix things, but it's not that volatile. The volatility is the spot price of oil. And they have a beta of 2, so the stock is pretty volatile. It moves 2 times the market. The stock has gone up 61% in the past 52 weeks. Pretty much all oil and gas stocks went up a lot the past 52 weeks, performing much better than S&P 500, which went up 12% in the same time period. The 52-week low is 22, the high is 39. The stock is on an uptick, trading above its 50-day and 200-day moving average. And this is a really popular stock. 10 million shares are traded each day. All the shares outstanding are on float. 71% are held by institutions, and a little over 1% of the shares are shorted. Right before COVID, they were paying their highest dividend of 47 cents, and they dropped that to 21 cents, but they brought it back up recently to 42 cents. Which is a 4.4% dividend yield. To calculate the dividend yield, multiply this by 4, then take that number and divide by the stock price. So as the stock price goes down, the dividend yield goes up. And as the stock price goes up, the dividend yield goes down. And they can easily afford this dividend. It's 59% of their net income, only 34% of their free cash flow. Looking at the nominal dividend payment is kind of irrelevant. You want to look at a dividend yield. And the dividend yield has been going up. It shot up really high when the stock crashed in 2020. And analysts are projecting the company to grow its dividend. Their ex-dividend is March 3rd. X means without dividend. If you buy it on March 3rd, you don't get a dividend. It has to be any time before March 3rd. And they actually pay the dividend on March 25th, which is 22 days from the ex-dividend payment. So if you buy the stock anytime between March 3rd and March 25th, you do not get the dividend. Their employee count is pretty steady year to year. They employ about 13,000 people. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $12,000 today. That's only 2% annual return. So you can see commodity stocks are very volatile. You have to really time it right. If you bought the stock up here or up here, it may take you years to see a positive return. But if you picked up the stock anytime over here or anytime over here, you'd be crushing it. Here's a list of the insider trading the past year. So there's only been buying, so that's a really good sign. This is a date, the person or company that bought, the number of shares, and the price. 63% of the shares are held by institutions and 37% by the general public. The biggest shareholder is Dodge & Cox at 3.75%. They have 54 million shares valued at 2.1 billion Canadian dollars. Then Vanguard at 3.25%, Fidelity, RBC, Royal Bank of Canada, and Sanders Capital. Let's look at their financial ratios. They have a great PE of 13.4. That's stock price over earnings per share. And the way you calculate earnings per share, it's net income over shares outstanding. The market median is 20, the average is 30. Generally, the lower the better for this ratio. This means investors are paying $13.40 for $1 of earnings. When you see a PE ratio below 13, that would imply there's limited revenue growth. But this company grew its revenue a ton. To give you an example, if a company like AT&T, which is a turtle, it generally doesn't have big revenue growth year to year. If they had a PE of 15 and Google had a PE of 15, the PE for Google is 1,000,000 times better because they're growing so much. Their revenue grows so much year to year. So you can't just look at one number, you have to compare it to a lot of other things. And they have a really good price to sales ratio of 1.4 and a really good price to book of 1.5. Price to book is stock price over book value per share. And the way you calculate book value per share is equity over shares outstanding. Equity is on the balance sheet. It's assets minus liabilities. Their tangible equity is $33 billion, so they don't have that much intangible assets. Let's look at their non-current assets. $65 billion of PP&E, property, plant, and equipment. $2.2 billion of exploration and evaluation assets. $1.3 billion of other. $3.5 billion of intangibles. Goodwill, copyrights, trademarks, patents. Those are all intangibles. And $160 million of deferred income taxes. Since this number is in the asset section, it will help decrease their future taxes. They have a good return on invested capital of 10%. ROIC is operating income times 1 minus the tax rate over equity plus net debt. Net debt is debt minus cash. They could cover their interest payments more than 5 times. That's operating income over interest expense. They have a really good ROE of 11%. That's net income over equity. Equity is assets minus liabilities on the balance sheet. They have a good current ratio of 1.1, current assets over current liabilities, so they can cover their current liabilities with their current assets. Their quick ratio is below 1. Quick ratio is current assets minus inventory over current liabilities. But I wouldn't be too concerned about this because they have so much cash flow coming in. Let's look at their current assets. $2.2 billion of cash. $4.5 billion of accounts receivables. This is how much money other companies owe Suncor. $4 billion of inventory and $128 million of income taxes and receivables. This is how much money the government owes this company in taxes. Let's look at their current liabilities. $1.3 billion of short-term debt, another $231 million of debt, $310 million on lease liabilities. This is how much money it owes on its leases. This could be the leases on its facilities. $6.5 billion of accounts payable. This is how much money Suncor owes other companies. $780 million of provisions. Provisions are money that's set aside for future expense. $1.3 billion of income taxes payable. Since this is a payable, this will increase their future tax bill. They generated over $7 billion of free cash flow in 2021. They have nearly $600 million of working capital. Their annual dividend payment is $2.4 billion, so they have over $5 billion of funding, so the company is well capitalized. The best way to look at ratios to compare them to companies in the same industry. There are 19 companies in the same industry as Suncor. The numbers for all these other companies are in US dollars, so I converted their numbers from Canadian dollars to US dollars, so it will be equal. And they're the 10th largest in market cap, so they're right in the middle, 44 billion US dollars compared to 76 billion average. They're the largest Canadian company on this list. They spend about half the average in CapEx. They're less leveraged than the average company, 0.5. The average debt to equity ratio is 0.7. They pay a higher dividend than average. Most companies in this industry pay a dividend. Their free cash flow is a little lower than average. This is the best way to compare companies, ratios, because it equalizes the companies. Because you can't compare the revenue or the free cash flow of Suncor to Exxon or Chevron. Of course, these two are going to be much bigger. But Suncor is a much better deal. They have a better price to book, a lot better price to earnings. Price to free cash flow is also a lot better than average, and price to sales is a little better than average. They're not growing, which isn't good, but most of these companies have negative revenue growth the past 3 years. Cenovus is 31%, which is pretty amazing. But they have one of the best ROA and ROEs of all the companies. ROA is a company's profitability in relation to their assets. ROE is a company's profitability in relation to its equity. So to summarize, I have them trading at a 17% discount, and they seem to be a much better value than most of the other companies in the oil and gas integrated industry. And oil is the #1 commodity in the world. It's so important. It's how we run our day-to-day lives. Almost everything in your house is due to oil. It's how we get around, whether by bus, car, plane. Electric energy is growing, but so is oil. Oil is growing every year. But people don't realize how much money was spent on the infrastructure and how many jobs rely on oil. And if oil gets really low again because people feel renewable energy is going to take over, pick up a lot of oil because it's going to come back up. The problem is oil doesn't increase forever. A company like Microsoft can increase forever if they continue making great products that people want. But oil goes up and down over time. That's why these companies pay a dividend, so they give back to the investors. They can't use the money for anything else. You could only expand so much. That's why a lot of tech companies don't pay a dividend, because they can keep expanding and growing. But with a commodity like oil, there's only a finite amount of oil in the world. I'm excited to see if my price target hits again in 3 months. That'll be pretty amazing. I rank their free cash flows 8 out of 10, their revenue 8 out of 10, and their ratios 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.